It happened in the second week of December. While the rest of the world was distracted by holiday shopping, the finale of Stranger Things series, and the endless noise of social media, the largest bank in the United States quietly released a document. It wasn't a press release. It wasn't a viral tweet. It was their official 2026 outlook. Usually, these reports are boring, full of corporate jargon and optimistic fluff designed to keep investors calm. But this year, the tone was different. Buried inside the charts and the polite language was a signal that contradicts everything we've been told for the last 2 years. We were promised a soft landing. We were told that inflation was dead. We were told that 2025 was the victory lap. But JP Morgan strategists are now flagging a different reality for 2026. A reality where the soft landing is exposed as a temporary illusion. And the most shocking advice in the entire report wasn't about buying the dip, and it wasn't about Bitcoin. It was a specific warning to anyone holding cash. If you are sitting on the sidelines waiting for safety, JP Morgan says you are walking into a trap. Why? Why would the most conservative bank in the world tell you to dump your safest asset right before they predict a potential recession? Is this a lifeboat, or is it a bait and switch? Welcome to Financial Stud, where smart money moves meet unstoppable success. Get ready to master your finances and unlock your true earning potential. Today, we are going to tear apart this 2026 prediction. We're going to look at the data they didn't put in the headlines. We're going to decode the slowdown narrative. And by the end of this video, you will understand exactly why 2026 is the year the financial rules change, and what you need to do to survive it. Part 1. The soft landing lie. To understand the danger of 2026, we have to look at the lie that sold us on 2025. Go back to late 2024. The narrative was perfect. The Federal Reserve had raised interest rates to fight inflation, and somehow the economy didn't break. Unemployment stayed low. The S&P 500 kept hitting all-time highs. It was the Goldilocks economy, not too hot, not too cold. Wall Street fell in love with a phrase: the soft landing. It's the economic equivalent of landing a 747 on a highway without scratching the paint. But here is what they didn't tell you. A soft landing isn't a destination. It's a transition. It's the moment of calm before the engine stalls. Throughout 2025, while the stock market was partying, the real economy was quietly bleeding out. American households were burning through the last of their pandemic savings. Credit card delinquencies started creeping up, not in a spike, but in a slow, suffocating rise. And JP Morgan saw this. In their private client notes, the tone was shifting. They noticed something called the downshift. The downshift is the technical term for what happens when the adrenaline wears off. You see, the economy of 2024 and 2025 was running on fumes: government spending and credit card debt. By the end of 2025, those fumes are gone. JP Morgan's chief global economist, Bruce Kasman, noted that consumption is expected to downshift in the fourth quarter of 2025. That is banker speak for the customer is broke. And this brings us to the core of the 2026 problem. The soft landing was based on the idea that consumers would keep spending forever. But the 2026 Outlook report admits that the labor market is cooling and that business caution is dragging on hiring. If businesses stop hiring and consumers stop spending, that's not a soft landing. That is a stall. And when an economy stalls at this altitude, it doesn't just glide. It drops. Part 2. The anatomy of the 2026 slowdown. Let's look at the numbers JP Morgan is actually looking at. Because the recession prediction for 2026 isn't about a single event. It's about a convergence of 3 specific forces. We call them the 3 cockroaches. Jamie Dimon, the CEO of JP Morgan, famously said, "If you see one cockroach in the kitchen, there are probably more behind the wall." Cockroach number 1. Sticky inflation. Everyone celebrated when inflation came down from 9% to 3%. But getting from 3% to the Fed's target of 2%? That is proving to be impossible. The 2026 report explicitly states that sticky inflation will likely remain a prevailing theme. Why does this matter? Because if inflation stays sticky, the Federal Reserve cannot save the economy. In 2008, when the economy crashed, the Fed cut rates to zero. In 2020, they printed trillions. But in 2026, if inflation is still hovering around 3%, they can't print money without turning the US into Venezuela. They are handcuffed. This is why the recession risk is 35% because the safety net is gone. Cockroach number 2, the Capex trap. The entire stock market rally of 2025 was driven by one thing: AI spending. Microsoft, Google, Amazon, they are spending hundreds of billions on data centers. This is called Capex, or capital expenditure. JP Morgan's report highlights an AI supercycle. They are optimistic about it. But here is the shadow side. History tells us that every massive Capex boom is followed by a digestion period. In the late 90s, we built too much fiber optic cable. In the 2020s, we are building too many chips. If these AI companies don't start showing massive profits immediately in 2026 to justify this spending, the spending stops. And if the spending stops, the construction jobs vanish. The tech contracts vanish. The market leaders, the Magnificent Seven, collapse. The 2026 outlook is betting on the AI boom continuing, but they acknowledge the risk of overenthusiasm. Cockroach number 3, the K-shaped fractures. This is the most dangerous part of the 2026 outlook. The economy is splitting in two. The K-shape means the rich people who own assets, stocks, and real estate are getting richer. The bottom half, people who work for wages and rent, are getting crushed. JP Morgan's data shows that while stock portfolios might be up, real consumer purchasing power is eroding. The bottom of the K is breaking. And you cannot build a sustainable economy on top of a broken foundation. When the bottom snaps, the top falls. Part 3. The get out of cash mystery. Now, we arrive at the most confusing part of the report. The warning that headlines this video. If the economy is slowing down, if there is a 35% chance of recession, if the consumer is tapped out, why on earth is JP Morgan telling you to get out of cash? Usually, when a recession is coming, cash is king. You want liquidity. You want safety. So why is the biggest bank in the world telling its clients to do the exact opposite? Are they trying to use you as exit liquidity? Are they trying to get you to buy the top so they can sell? The answer is actually scarier than a conspiracy. The answer is financial repression. Let's look at the cash trap. Right now, in 2025, you might be enjoying a nice 4% or 5% yield on your savings account or money market fund. Feels safe. Feels smart. But JP Morgan knows what's coming in 2026. The Federal Reserve is expected to cut interest rates to try to keep the economy alive. When those rates drop, your 5% yield becomes 4%, then 3%, then 2%. But remember cockroach number 1, sticky inflation. If rates drop to 3% but inflation stays at 3% or 4%, your real return on cash is 0 or negative. This is the warning. JP Morgan is saying that in 2026, cash is a guaranteed loss. Sitting in a savings account will slowly bleed your wealth away through inflation. So when they say get out of cash, they aren't telling you to go gambling. They are telling you that the safe zone has become a kill zone. They want you to move that money into assets. Stocks, bonds, real assets, anything that can outrun inflation. But this creates a terrifying dilemma for the average person. You are being forced to choose between keeping cash and losing money to inflation. Be investing in the market right before a potential recession. It's a rock and a hard place scenario. And this is exactly where they want you. The system is designed to force your capital into the market to keep the asset prices inflated. Part 4. The 2026 scenarios, what happens next? So, how does this story play out? Based on the JP Morgan outlook and the hidden data, there are 3 scenarios for 2026. You need to identify which one is happening so you can react before the crowd. Scenario A, the melt-up probability, 40%. In this scenario, the get-out-of-cash crowd rushes into the market. The AI bubble doesn't pop, it expands. The S&P 500 hits 7,500. Feels like euphoria. But this is a crack-up boom. It's inflation disguised as growth. The stock market goes up, but the price of bread and gas goes up faster. You feel richer when you look at your 401k, but you feel poorer when you go to the grocery store. This is the outcome banks prefer. It keeps the system solvent, but destroys the middle class. Scenario B. The slow bleed probability, 35% the recession prediction. This is the scenario JP Morgan is hedging against. The consumer finally breaks. The downshift turns into a halt. In this world, the AI spending hits a wall. Tech companies miss their earnings. The layoffs move from quiet trimming to mass firing. If this happens, holding cash was actually the right move, but only if you timed the bottom perfectly. JP Morgan strategists are betting that even in this scenario, high-quality bonds will outperform cash because rates will be cut aggressively. Scenario C. The black swan probability, 25%. Geopolitics, trade wars, a new supply chain shock. The report mentions fractured geopolitics as a major risk. If a war escalates or a major trade route closes in 2026, inflation spikes while the economy crashes. This is called stagflation. It is the nightmare scenario where both cash and stocks lose value. Conclusion. The 3 takeaways. The 2026 outlook is not just a PDF. It is a warning shot. The era of easy money, the era of the soft landing, is officially over. We are entering the era of the grind. Here are your 3 takeaways to survive 2026. 1. The soft landing was a narrative, not a reality. Do not base your financial decisions on the news telling you everything is fine. Look at the data, consumer debt, delinquency rates, and sticky inflation. 2. Cash is a wasting asset. JP Morgan is right about one thing: inflation is here to stay. Holding too much cash in 2026 ensures you lose purchasing power. You must find assets, whether it's stocks, bonds, or real estate, that yield more than the inflation rate. 3. Watch the 3 cockroaches. Keep your eyes on inflation, AI Capex, and the consumer. If any one of these breaks, the 35% recession probability jumps to 100%. The banks are positioning themselves for volatility. They are telling you to move your money so they have liquidity. Be careful. Be skeptical. And most importantly, be prepared. If this sparked something, like the video, hit that subscribe button, share with your friends, and turn on notifications. I'll see you in the next one. Stay studious.